Sid, let's begin with this idea that with all the political risk out there, how on earth are we seeing record closes? Yesterday it was the Nasdaq, a few days ago it was the Dow.
Yeah, there have been many excuses to account for the global market rally. As you say, we've seen exchanges reach record highs. But I think technical indicators are very important and probably underappreciated. Specifically, the outlook for net supply of equity. In 2016, the supply of net equity was actually fell for the first time ever, and in this year, net equity supply is projected to actually flatline, and that's because share buybacks, we all know, and they've received a lot of attention, share buybacks as well as leverage buyouts and M&A, i.e. activity that tends to decrease the outstanding stock, has actually offset activities that increase the outstanding equity stock. So we've had a very benign outlook for supply, and that's really helped to juice asset valuations.
But surely, Sid, less supply would actually, you would think, push up prices.
So we've seen that obviously in the equity markets, but there's also an interesting story in debt markets. We've seen that investors are very much cash rich, and although we've seen this big rally in terms of primary markets, we've seen a big increase in issuance in growth terms. In debt markets, you've actually seen investors being very cash rich thanks to a wave of redemptions and a wave of coupon payments that will boost investor firepower to soak up an increase in gross debt supply in investment-grade bonds.
Which this chart shows us. This great rotation, Sid, that we've all been talking about, I mean, the evidence shows it's yet to materialise.
Yes, after the election, you saw retail investors try and fall in love with equity stocks, but we've seen that equity funds have not really been courted by retail investors for a long while. We've seen that flows into bond funds have actually increased in recent weeks, and therefore this great rotation, as you say, hasn't really materialised. So that's a good technical indicator to try and boost bond markets. But I guess what's interesting is that though retail investors haven't fallen in love with equity funds, the fact that global equity supply in net terms are set to be flat this year, that's a technical indicator that suggests that actually stocks can continue their upward trend thanks to the fact that there's not a huge amount of supply there.
And gold it's in favour. Stan Druckenmiller, you know, the billionaire investor, he's got a great track record, hasn't he? He's back in gold. He was out of gold post-election. He's back in gold. And there's a lovely chart, isn't there, which you were highlighting, you know, only a few days ago. VIX versus gold ETFs. There's a spread, isn't there? And that's just one of those charts that shows the unease underneath this lack of volatility. Yeah, we've seen, well, many people might get annoyed by the suggestion of gold. Gold is always this indicator that suggests that, you know, anyone uses it as an excuse to buy gold. So now we are seeing inflows into some gold ETFs being relatively strong, which some might say is an indicator to hedge against some risks or the rise of inflation. But global policy uncertainty is also really high. And the relationship between gold and other metrics out there is actually quite complex. Probably what's interesting is that as relative interest rate differentials increase, we might see the relationship between gold and demand change. So yeah, there's a lot of different scenarios going on.